Welcome back to the Deep Dive. This is your weekend briefing, and as we look back on the week ending December 12th, the market has left us with, well, a lot to unpack.
It really has. We're in this fascinating, almost confusing macro environment.
It's a total tug of war, isn't it? You have the Fed easing rates on one side, trying to support growth.
But on the other, you've got this really stubborn, tariff-driven inflation that just keeps that fear factor high.
So our mission today is to look past those headlines. We want to see how that conflict is showing up in the market structure, in the liquidity dynamics, and most importantly, where institutions are placing their bets as we head into the quiet year-end period and look toward Q1 2026.
And I think the core theme from everything we're seeing is this idea of a tentative equilibrium. It feels very fragile.
Tentative is a good word for it.
It is, because if you just look at the headline S&P 500, you might think things are calm. But when you start to, dig into the plumbing, the volume, the VIX curve, correlations, you realize that quiet is pretty deceptive. We need to figure out where the real conviction is.
And it sounds like last week that conviction was, well, it was hiding.
It was very, very guarded.
Okay, so let's start there with that guarded defense. Looking at the charts as of Friday's close, the major benchmarks gave us a textbook signal of just pure indecision.
They absolutely did. You look at a weekly chart of the S&P 500, and you see what technicians call a doji, or a spinning top candle.
Which, for our listeners, just means the market opened, it moved up, it moved down, but ultimately it closed almost exactly where it started for the week.
Precisely. It's a visual representation of a complete stalemate between buyers and sellers. No one won the week.
And the critical part here isn't just the shape of that candle, but, where it formed, the ground it was standing on.
That's the whole story. That indecision happened right at a huge long-term technical support zone. We're talking about the low from the prior quarter, a significant risk level.
So this is where the big institutional risk models have their fences, so to speak.
Exactly. The market ran down to that fence, touched it, and just stopped. It held the line, but it was far from a decisive victory for the bulls.
Right, so it defended the level. But the big question for me, and I think for everyone, is always volume. Was this a passionate, conviction-fueled defense, or just a slow retreat that sort of ran out of steam?
And the volume narrative, it points very strongly towards the latter.
Not a lot of passion then.
No. Weekly trading volume was average, maybe even slightly below average. That was just enough to stop the bleeding, to prevent a breakdown below support.
So there was some buying, maybe from systematic funds rebalancing, or...
Right, or long-term investors nibbling. But, and this is the key, it was not enough volume to signal a conviction-driven reversal.
Why is that lack of expanding volume so important? I mean, prices stopped falling. Isn't that good enough?
It's not, because a true sustainable bottom, the kind that gives managers confidence to really deploy capital, it needs force. Yeah. It needs momentum, and you usually see that signaled by a big spike in volume on the defense.
And without it?
Without it, the defense is just guarded. It means the door is wide open for a retest of those lows, especially as we head into this week, where liquidity is naturally going to start drying up. It was a pause, not a real commitment.
That makes perfect sense. So we're standing on shaky ground, not solid rock. Okay, let's use that as a pivot. From a lack of conviction in price, let's talk about what the market is anticipating in terms of future uncertainty.
Let's talk volatility.
The VIX Index, the fear gauge, it was pretty subdued last week, wasn't it? It just sat there in that neutral 17 to 19 range.
Yeah, and that spot VIX reading, it lines up perfectly with the Fed's recent signal. I mean, they just cut rates in December, dropping the target range to 3.5 to 3.75%.
So that keeps immediate anxiety pretty low.
It does. But that's where we have to look for the hidden hedging.
Yeah.
And that's always in the VIX term structure. We need to see what the market is quietly pricing in for the future, not just for today.
And what's fascinating is the curve is in contango, which is normal, it's healthy. It means future volatility costs more than today's. But the steepness of that curve, the rate at which it's rising, that seems to be telling a very specific story about 2026.
It is. If you pull the data from last week's close, the front month, the December 2025 VIX contract, it was low, something like 12.92.
Very low.
But then you look out to January 2026, and it jumps to 15.61. And then look at the spike out to September 2026. It's all the way up at 22.90. That is a steep, steep upward slope.
And that's not just the normal passage of time. That's a genuine signal of anxiety, isn't it?
It's a genuine signal of forward-looking anxiety. They are actively hedging risk in the first and second quarters of 2026, And the question is why?
Well, the tariff-driven inflation you mentioned, that's structural. That's harder for the Fed to control.
Exactly. So the market is worried about that persistence, and it's worried about a potential policy misstep if the global growth engine starts to slow down. It's telling you they expect a bumpy ride once we get out of the holiday season.
And we're seeing some of that anxiety in the bond market too, right, with the MEE index.
We are. Rates volatility, which we track with the MOVE index, you can think of
Mhm.
it as the VIX for bonds, it's still elevated compared to where it was pre-2022.
So the bond market is still on edge.
Very much so. It's a critical signal that the fixed income world is extremely sensitive to any surprises in the economic data or,
Yeah.
in any expected comments from central bankers. The policy path is still the central risk.
Okay, let's move on to liquidity, which is so critical for anyone trying to navigate these next couple of weeks. We have this dual reality happening.
You do.
On one hand, the Fed is providing this massive systemic backstop. But at the same time, the actual day-to-day trading environment is getting razor thin.
And this distinction is absolutely vital for you to understand whether you're managing a massive fund or your own account. You have to separate systemic liquidity from market liquidity.
Okay, break that down for us.
Systemic liquidity is about the health of the banking system, the plumbing. The Fed, by buying T-bills again, targeting $40 billion a month, is providing a huge backstop there. They're making sure the financial gears don't seize up like in 2008.
So that's the good news. It prevents a catastrophe.
It does. But then there's market liquidity. The ability to actually buy or sell an asset right now without moving the price against you.
And that's the bad news.
That's the bad news. Market depth is showing all the classic signs of year-end thinness. The big institutional desks are scaling back. The order books are shallow.
Which dramatically increases tactical risk.
It's like systemic liquidity is having a deep ocean so you don't run aground. Market liquidity is trying to turn a supertanker in a tiny, narrow channel. If an unexpected large order hits the market this week, it can trigger a huge price swing just because there's nobody there to take the other side.
That is the classic year-end trap. You get caught in a sharp, low-volume move that just evaporates a day later.
Exactly. And we also have to remember the connection to the real economy. The Fed is helping the banks, but credit conditions for actual households and businesses, they're still facing challenges.
Despite the rate cuts.
Despite the cuts. And if credit stays tight for Main Street, that eventually hits corporate earnings and feeds back into the market. Systemic health doesn't automatically mean robust economic growth.
That's a great point. Speaking of performance, let's talk about the big one, the 60-40 portfolio. For a couple of years, that traditional hedge just failed because stocks and bonds moved together.
They were positively correlated. A disaster for diversification.
But our sources suggest that is finally set to change. We're expecting those correlations to fall in 2025 and 2026 as inflation cools off.
This could be the most important structural shift for portfolio construction. We need fixed income to be a diversifier again. But if we dig a little deeper, we need to look at intra-equity correlations too.
So how individual stocks are moving relative to each other.
Exactly. And right now, those correlations are moderate.
Which is a good thing for stock pickers, right? It means fundamentals are starting to matter more than just the macro tide.
Precisely. When correlations are moderate, it creates an environment that really supports active management. You get rewarded for doing your homework on individual companies. But there's a huge warning signal that comes with this picture.
Okay, and what's that?
It's the relationship between credit and equities.
Still tightly linked.
Very. The correlation between credit spreads and stocks is still strongly positive. Credit spreads are just the extra yield companies have to pay to borrow compared to the government. If they widen, it means borrowing costs are rising because of default risk.
So what's the action item for the listener here?
Watch credit spreads like a hawk. The credit market often smells smoke before the equity market sees the fire. If you start to see high-yield credit spreads widen out significantly.
Meaning corporate borrowing gets a lot more expensive.
Right. If that happens without an immediate plunge in stocks, that is a powerful early warning sign. It suggests the bond market is bracing for a downturn that stock investors haven't priced in yet.
A very clear signal to watch for. Okay, let's bring it all together in the Smart Money Playbook for late 2025 and heading into 2026. What are the big rotations we're seeing?
The first one is a clear move in fixed income. We're seeing a rotation out of cash and into high-quality bonds, specifically in that 2 to 5 year maturity range.
Locking in those attractive yields without taking on too much duration risk.
That's the play. The 10-year Treasury yield is expected to stay in that 3.75% to 4.25% range for 2026, which is very compelling. Core fixed income is really being seen as the primary source of portfolio resilience right now.
And on the equity side, valuations are high. It seems like the buy everything approach is over.
Oh, absolutely. The long-term outlook is still positive, with AI and earnings,
Hmm.
but the near-term strategy has to be selective. There's a lot of caution around the Mag 7 mega cap tech names.
The concentration risk there is huge.
It is. So we're seeing calls for a potential rotation out of those names and into some undervalued sectors, maybe energy, maybe housing, or even into small and mid-cap stocks that have lagged.
Okay, so a cautious rotation into quality bonds and a more diversified, selective approach to stocks. How does that translate into probabilities for the week starting tomorrow, December 15th?
Based on our analysis, the most likely path, we put about a 35% probability on it, is a range-bound market with a downside skew.
So, choppy trading.
Choppy trading, inflation data that's still sticky, and growth that's just moderate. Not enough to justify a big breakout higher.
So, if that's the backdrop, what's the recommended stance? How do you position for a choppy market that leans negative?
The guidance is pretty clear. You need to be balanced, you need to be nimble, and you need to be risk-averse. The priority right now has to be capital preservation, not chasing aggressive bets in a thin market.
And tactically.
Tactically, it means maybe maintaining some modest strategic long volatility hedges. Think cheap. Out of the money, puts on the SPX as portfolio insurance, and crucially, keep a healthy cash allocation. You need that dry powder to capitalize if we get one of those weird liquidity-driven dislocations.
It really brings us full circle. The market held that key support last week, but the way it did it on muted volume, it just screams caution.
It does. And the final takeaway for you is you have to maintain extremely tight risk parameters over the next 2 weeks. Prioritize positions in things that are highly liquid. Remember, the Fed is backstopping the system, but they are not protecting your portfolio from a sudden price gap in an illiquid market. That risk is on you.
And that leads us to our final provocative thought for you to think about this week. We talked about that VIX term structure and how it's hinting at growing anxiety for the first quarter of 2026. The critical question is this: how steep does that VIX curve need to get before it forces a decisive defensive shift in broad institutional positioning? At what point does that forward-looking alarm bell get so loud that it overrides this current guarded defense and actually triggers that downside skew? Keep a close eye on that steepening.
We'll see you next week.